Are you thinking about buying a home but are worried about having to put a whole bunch of money down? Or are you a real estate agent who assists first-time homebuyers? Then you won't want to miss our topic today as we discuss low to no down payment options for purchasing a home. Hi, I'm Joe Harris with Morgan Financial. This is your Keeping Your Business on Track episode. I'm here with my buddy, Nick Morgan. How you doing, Nick?
I'm doing great, Joe. How are you?
I'm awesome. Hey, so, there's a lot of people that they get discouraged from buying a home before they even start the process. Yeah, you need that mic.
If you didn't hear me, I am doing fantastic.
Okay, good. So a lot of people, we're talking about low down payment options in buying a house. And we found in doing research, and if you look on the internet, you'll see that the biggest barrier to entry in people's minds is the down payment itself.
Mm-hmm. For sure, yeah. And I definitely like talking to buddies and even talking to people around my age that, again, that notion that you have to put 20% down for any home purchase, it's definitely a myth out there. But yeah.
It's still so strong out there. I mean,
Yeah.
it's crazy how many people that don't own homes because they think they have to have all this money to put down. Now, I'm not saying that putting more money down isn't a good idea,
Right.
but one of the biggest determinants of wealth in this country is home ownership. And there's all kinds of stats on buying a home and building wealth. And so, just because you don't have the down payment doesn't mean you don't have the same ability or options out there to buy a house and hopefully start building wealth.
Mm-hmm. Yeah. And there's, like we're going to talk about today, there's a ton of possibilities for just getting into the home and starting to build that equity, starting to build that wealth, as you just talked about. Yeah. So cool.
Okay.
If we want to get right into it.
I do want to
Cool.
get right into it.
The first, it's kind of, we're going to go through a little bit of the different loan types and what they offer, and kind of how low you can really go. And if we start with first the FHA loans, maybe you could talk a little bit about the minimums on that and how you could do that.
Sure.
Yeah.
Well, FHA it does not stand for first time home buyer. Okay,
it does
FHA. People think it's a first time home buyer program,
Right.
And it can be, but that's not. It stands for Federal Housing Administration, and it is meant to help people get into homes, and it's government backed loan.
Right.
And that's not really that important to the borrower. It's more important to the lenders, quite frankly. But FHA requires a minimum of 3.5% down. And believe it or not, out of all the options we're going to talk about today, it has the highest down payment requirement.
Interesting.
And most people think it is the lowest down payment requirement.
Right. Yeah.
So FHA, highest down payment requirement. It's the right loan. It's sometimes the right loan. It has a little bit more features to allow people that might have questionable credit or a little higher debt to income. That's the amount of money you bring in versus the money you spend every month that you have to. So it has a little bit easier credit qualifying components, and so it's a lot of people just go to it and they come in saying, "Look, I need to do an FHA loan." And it goes back to what we've always said. It's like if you go in and tell people this is what I need, well, a lot of people are just going to give you what you want. The reality is there's other options out there that might be better suited for you, but it depends on the individual. So FHA is a great loan for the right individual, and it does have mortgage insurances attached to it. And if you're putting 3.5% down, you're going to have mortgage insurance on the loan for as long as you have that loan.
Yeah, the life of the loan. Yeah.
Life of the loan, regardless of how much equity you build or put in there. So that is a discouraging factor of the FHA. And plus, there's not only a monthly component, but there's an upfront premium that's baked into the loan. So FHA is a great loan for the right person, but there's also other options out there.
Yeah. Yeah. Just to start, the first option, right? And like we said, it's 3.5%.
3.5%
for that FHA.
Yep.
So then moving on to conventional loans, what are some of the minimums or the products that you can do with conventional?
Okay, so conventional is a term that gets thrown out a lot by us and other people out there. And really, conventional just means it's not a government loan.
Yeah.
So if you want to put loans into two categories, there's conventional and conventional and government, right? And everything fits in those two. Now, conventional it breaks off into conforming or non-conforming. And so conforming means it conforms to Fannie and Freddie. Those are the quasi-governmental agencies that help create liquidity for the mortgage markets, really. They buy loans so that we can continue to do more loans. And so Fannie Mae and Freddie Mac have a 3% down. So remember, FHA is 3.5%. Fannie and Freddie have different products for 3% down. Now, some of those products are more geared towards the first-time home buyer. There's the Home Possible, Home Ready. They're 3% down, but they have either income or geographical limitations to them.
Right.
And not to get too specific, but they might have an income limit. You might have to be 80% of your AMI or area median income. And these are all things your loan officer can help you with. But just to know that conventional conforming products, Fannie and Freddie, which are typically, not always, but typically more favorable on your rates than, say, a non-conforming product. They also call them non-QM, non-prime. In the distant past, they used the naughty word subprime, which is gone. Now they call it non-QM or non-prime, and they're not nearly as bad as they used to be. They're totally different products, but the conforming products, Fannie and Freddie, Home Possible, Home Ready. There's a couple other ones, but they offer the ability to go down to 3% as a down payment, which is lower than the FHA requirement.
Right. And one other thing to note is the PMI, the private mortgage insurance on that, but that does go away once you hit that 20% equity mark.
Well, yeah, there's a couple different ways you can get rid of your mortgage insurance, and I'm pretty sure we're going to do a podcast on that upcoming in the next couple of weeks. So if you're not a subscriber, please like, share, subscribe. Do that now so you don't get to the end of this and forget to do it, because we have some great content in this series of first-time home buyer and type things like that. So go ahead and hit the subscribe button. You're going to like what you hear. If you don't, you can unsubscribe later. Yeah. But go ahead and like it too. Yeah. So going back, sorry for the shameless plug. Sometimes you just got to get that in there. But going back to conventional products, there are some good options. And if you have good credit, or there's some other features that it has some good rates and potentially lower costs on your mortgage insurance and things like that. It's a really good thing to compare against FHA if someone's only showing you FHA.
Yeah, for sure. And one small little thing that I was just thinking about right now, comparing a 3.5% or a 3% a down payment, it's a 0.5%. But when you're talking about that in houses that are hundreds of thousands of dollars, like that number can actually be a pretty large portion of money, right?
And what's crazy is we're finding right now that first-time home buyers aren't necessarily in the lowest of price ranges. FHA only goes up to $400 and some thousand. Sorry for not committing that number to memory. Whereas a conventional conforming loan can go up to $766,000. Someone's going to correct me under here. So go ahead and just do it now. Tell me the conforming limits. Sorry, the public math just got to me. But I think it's $766,250, somewhere around there. We'll put the real number down there.
Yeah, I wish I should know that too. But my bad. I can't save you right now. I'm sorry.
You can't save me. No, it's okay. I don't mind looking foolish every once in a while. That's a number I would definitely look up before I committed to it. But my point is that you definitely have a lot more leeway in the purchase price and the loan amount in a conforming conventional loan versus FHA. And we're seeing first-time home buyers buying $600,000 and $700,000 houses right now. And FHA wouldn't be an option for that if you're putting 3% down. Okay. So in the higher price ranges, FHA isn't even an option. And some areas that's almost a starter home. I mean, our area that's kind of on the higher side. But some areas that's if you're Southern California, DC, other metropolitan areas, $700,000 might be a starter home. So there might be first-time home buyers who have good jobs and they've saved up money and that's their first home.
For sure. Yeah, absolutely. Okay. So then moving back to the government side, we then have VA loans.
VA loans.
So what are we looking at with VA?
Well, let's make something very clear. You have to be an eligible veteran to be eligible for a VA loan. And the VA it could require no down payment if you have VA eligibility and you qualify. You have to qualify for all these loans. So don't think you just get these loans. You have to qualify based on their standards. And the VA loan it is my favorite loan. I mean, we are veteran owned, operated, and focused. So obviously we do a lot of VA loans, and I like to think we're extraordinarily good at them. That's me patting myself on the back, or our company on the back, but that is our pride and joy is helping the veteran out. But on a VA loan, it's 100% financing. It can be up to 100% financing. They do have a VA loan guarantee, which really guarantees the loan against default to the lender, right? And the veteran's still typically responsible in many cases. But it's has very good interest rates, very competitive, if not better than conventional, or there's no monthly mortgage insurance. And that upfront fee, there is an upfront fee, but it can be rolled into the loan. And the VA will also, the seller can pay all normal and customary closing costs, which is nice, and up to 4% of sales concessions, which would be like, if a builder wants to throw in paying HOA dues or things like that. So it makes it very attractive for the veteran to get in with very little money of their own.
Yep. Zero. Well, for the payment, down payment.
Potentially zero. Yeah. I don't like to say zero because it depends on their situation. They got to qualify. They got to be eligible. But VA and the VA, do you know what I'm going to put you on the spot, Nick. Let's see what you learned these days. But do you know what the minimum or the maximum loan amount for is on a VA loan, according to the VA?
There is none, correct?
Yes. Good job.
Okay.
You do pay attention.
I do.
No, I'm kidding. Yeah,
I try my best.
I know you're a smart kid. But all right, look. So VA, awesome option.
Yeah.
And no minimum down payment. Maybe it's your first home and you're buying $1 million home and you qualify. VA is an unbelievably good option for that. Now, you want to compare different loan types together, but if you are an eligible veteran and you're looking at $1 million loan or a $700,000 loan, definitely take a look at the VA versus its conventional brethren, and you'll see what I'm talking about.
Yeah, it's just a fantastic product, especially for first-time home buyers, because like you said, no mortgage insurance, 0% down. Yeah, it's great.
Yeah.
Cool. All right. Then the last one on the government side is USDA loans.
USDA.
Yeah. So what are some of the qualifications? What's that one all about?
The USDA is a rural loan. That's a hard word to say. Rural loan, and basically it only applies to specific areas that are deemed rural by the USDA. And the USDA, it's actually the same organization that brands your beef. And so the USDA loans are they're more lenient credit qualifying. They're a little bit. They do have no down payment requirement. Now, obviously, you have to be in an eligible area, and you have to qualify. But it is a good loan, especially if you live in an area deemed rural. It potentially could potentially be better than a VA loan. Even now, you want to compare them side to side, rates, fees, payments. But there also is no mortgage insurance on a USDA loan.
Yeah,
so
for
it's
sure.
very attractive. It is a government loan, and what that means is the government backs it against default as long as you underwrite it to the standards the government sets. Great product. We don't have a ton of USDA where we live, but there's plenty of areas in Florida, all throughout the country that have USDA. Now, it's only for primary residents. This is one thing I didn't mention from the very beginning. These are for first-time home buyers that plan on living and occupying the property. All of what I'm talking about. FHA, primary residents only on a purchase. So VA on a purchase, primary residents only, USDA, and 3% down conventional. All for primary. You're going to live, occupy the property.
Gotcha. Yeah, that one, a little bit different than the VA loan, but a lot of similarities, right? The 0% down payment, which is fantastic.
Right.
The no MI, which is fantastic. So yeah, definitely something to consider if you're in one of those areas. We're not in that area. We're not. Like
we have a couple little pockets, but
but
not really our cup of tea. But
exactly.
It's something. If it is an option, it's something to definitely take a look at. So. Anything other questions? Yeah,
so one more, that there may be state or local programs that might be offered for that down payment, and if you could touch on those a little bit.
Okay, so you might hear the term down payment assistance or bond loans, and basically these are, like you said, state or local government assistance programs. So they get grants or different monies. A SHIP program is one of them. There's various down payment assistance programs, and basically it's community allotted money for the purpose of purchasing a home. And typically you have to be able to show these people that you kind of need the grant or the money, but you have to be able to show a lender that you can qualify for the loan. So not everyone fits within that realm. There's some that are more lenient than others, some that don't have as strict as qualifications. Most of them are not forgivable. Like they might not have a payment on them. It might be a silent second mortgage that gets paid off when you sell the home, or there might be a payment on them. It's just very important to get all the details. These aren't necessarily bad, but make sure you get the details to know, do I have to pay this back? Are there tax implications? Is this money going to be ready and available when I'm actually have a contract and purchasing a home? We've seen a lot of clients get sold, on this particular grant program, and they go out, shop for the home, find a home, and then they write up a contract and they come back and they ask the lender, hey, I'm ready. Where's my grant? Oh, I'm sorry, we ran out of money.
Yeah.
There's no money left for you.
Yeah.
And that's tough. But again, if you qualify, and not everyone does, it might be something to look at to see hey, is this a good thing for me? Compare it side by side. Make sure just because you're getting free money doesn't mean it's actually free. Mm-hmm. Make sure you compare. Are the interest rates on the first mortgage going to be the same as, say, going somewhere else and not getting free money? And what does that math look like? Mm-hmm. To me, people can say whatever they want to say, but the math is what's important here. Does it make sense for me to take free money, even though it's at a lower, a higher, longer term, different term, or go with a conventional or a normal non-down payment assistance or grant or bond money loan? What makes more sense for me? It doesn't always make more sense to take the free money, but in many cases it does. So it's a good thing to look at if you're eligible and qualified.
Right. Yeah. Just take some time, maybe do some research, see what's out there. You know what I mean?
Absolutely.
But, yeah. And that wraps up.
And I was going to say, and ask your loan officer who maybe a good loan officer, even if they don't do the program, will know about it and be able to say, yeah, you might want to take a look at that. You look like a good fit. Here at Morgan Financial, we teach our loan officers to do the right thing for the client, even if it means us not getting the loan. Because we know if we give people good advice, they're going to refer their friends and family to us to get good advice. And they'll say, look, even if they can't do it, they'll tell you who can and who might be a better fit. And that's how we like to operate. But, this isn't necessarily about us. But if you do need help and we can help in any way, maybe looking at options or just want honest advice without a whole lot of, a lot of strings attached, we would love to give it to you. So please give us a ring. That's all we got, I think, right?
Yep. Yeah,
cool.
That wraps everything up.
Well, thanks for watching today. We hope you got some value from this. Like, share, subscribe, and we'll see you next time.